Good evening, everyone. Welcome to our year in review webinar. We're going to be taking a look at what we saw in the M&A market in 2021 and sharing our outlook with you for 2022 dental M&A. Really excited to review everything with you this evening. I am Maggie Jarrett. I am the Director of Business Development for TUSK Partners. I'm relatively new to the team and am really the tip of the spear when talking with prospective clients who are interested in working with an advisor such as TUSK to help bring on an investor partner for their practice. I joined TUSK from a private equity firm called Cedar Investors, where I worked on healthcare M&A and specifically served on the board of Cedar's dental platform. I'm joined tonight by Kevin Cumbus, co-founder and president of TUSK. Kevin has a deep background in both dental and banking and M&A. His father was a pediatric dentist. Kevin then worked across a number of banking and dental organizations before forming his own DSO, Mundo Dentistry, and ultimately founding TUSK to help sellers realize maximum value for the practices that they've worked hard to build. And in addition, joining us this evening is Ryan Mingus. Ryan is the Managing Director of Mergers and Acquisitions for TUSK. Ryan's background is also really deep within healthcare and M&A, most recently joining TUSK from Align Technologies. Really happy to have everyone here tonight for the discussion. A little bit more about TUSK. So we are a sell-side M&A advisor exclusively focused on the dental space. We work across all dental specialties and have 9 fully dedicated team members to help work through transactions with our clients. Our team is really split about 50-50 between business development M&A and analytics and marketing. And we work hand in hand with our clients throughout the entire process. Collectively, we have 40 years of dental industry experience. And as a team, we've closed north of $600 million in dental transactions. So TUSK is really the nexus of finance, investment banking, private equity, and dental, DSOs, and healthcare. This slide right here illustrates our collective experience. And what you'll see is that we really truly, having come from the buyer side, understand what buyers are looking for in their dental investments and how we can help you as sellers maximize the value of your transaction. I would love for everybody to please, if you have questions, be sure to submit them in the Q&A box below. We will be reaching out to each of you individually and directly after the webinar has concluded. Kevin, I'd love to hand it over to you right now to have you weigh in.
Thanks so much, Maggie. It's really good to be back with everybody this evening. 2021 was an incredible year. Looking back 12 months ago, Ryan, we had just come off of closing 6 deals in 24 hours at the end of the year. We had some deals that didn't get closed that were COVID related that we had to close in that first quarter. COVID kind of reared its ugly head again. We've got all these exogenous forces coming in, the Biden potential tax change, the likelihood of long-term capital gains looking like ordinary income tax rates, people hitting the panic button a little too late and saying, all right, I thought maybe I'll hold on, but shoot, now I need to sell. It was a pretty wild year, all said. I mean, we had, by the time it was all said and done with, we scaled up the team, added 4 additional team members to help you on the M&A side, and closed a total of 20 transactions over the course of the year. We did it in every specialty nationwide, and I'm really proud of the team's effort, but I'm happier for the results for our clients. They entrust us with their life's work, and it's just a pleasure to get to do what we do. I'm excited to get to the numbers. I'm excited to see kind of what you're seeing in the market historically, and also where you believe and where we believe this market is set to go for the years to come. It was certainly one of the busiest, if not the busiest, M&A years across the entire U.S. economy. We saw more private equity dollars put to work than ever before. we played a role in the formation of a couple of new private equity backed groups, and now we got more demand than ever out there. So it was quite a year from my perspective. Ryan, I'm going to hand it over to you. I know you've got the numbers set aside here, so I'm eager to see what you have for us.
Thanks, Kevin, and also thank you, Maggie, for teeing us up today. I know a lot of folks are interested in seeing the numbers, so we're going to get right to it. As Kevin mentioned, there were 20 total transactions for TUSK in 2021 across every specialty, a couple new specialties for us. And like you said, 3 new platform deals. So some of you folks on the webinar might be interested in forming your own DSO and your own image, and continuing on with some capital and a well-run board of directors, perhaps. We can certainly deliver that for you. And we did across a couple different specialties actually this year. $430 million of total transaction value. Our deal size definitely increased quite a bit in 2021 versus 2020. I think there are a couple of reasons for that, and we'll certainly dive into that a little bit later. I think my favorite stat for us whenever talking with potential new clients is our ability to go very broad for our clients and bring the market to them. And that's reflected in the 17 different buyers for our 20 deals. We pride ourselves in adding value through running a competitive marketed process. And our clients might think that they know what they want when they go to market, but ultimately once the market comes to bear, and they start understanding cultures and they start understanding deal structures and the value of various deal components of deal structure, they ultimately end up going a different route than what they had in mind when they went into this. And then the last number I want to touch on here is the 70% specialty versus 30% GP. I think we've got a couple of reasons that we'll share as to why that is. But that was a really interesting stat because we were kind of 50-50 in 2020.
Yeah, that's right.
So certainly a move, but we think that there's some signals in the marketplace that we feel that GP deals will kind of come back into favor.
Looking at that unique buyer stat, and remembering our comps and who the buyers were, Ryan, some of these buyers have been around for some time. Some of them are relatively, call it relatively new, 3-4 years young. And what I love about what you and your team did is you identified some pretty great groups that had yet to gain exposure to certain states or certain geographies or certain specialties. And through having strategic conversations with their leadership, really finding great partners that are clients of ours, where you're going to form partnerships where 1 + 1 = 4 in the years to come. Yep. That's really creative M&A activity.
Yeah, absolutely. Good point. So here we'll flash this. This is a lot of numbers and probably impossible for those of you to read that are on your cell phone observing this evening. But ultimately, these are all the comps for our deals in 2021. You'll see a wide range of specialties, and probably the widest range lives in the multiple of EBITDA. We would definitely want to call that out because the multiple of EBITDA is always gets thrown around a lot. What multiple did so and so get? What multiple did such and such DSO get? The multiple matters. We're not here to say that it doesn't matter. However, there are many, many, many other factors that go into the decision-making process for our clients, irrespective of the multiple that gets applied to that. I think maybe just a very few number of our clients ever took the highest enterprise value and as such the highest multiple that was applied to that. But when folks are out there, I just encourage you all to take multiples with a grain of salt, because it's always a multiple of what EBITDA. And that's where we really spend most of our time with our clients, is making sure that we get their EBITDA number right before we ever go to market. Anything else you want to share on this before we kind of dive in a little bit deeper on some of the nuances of these deals?
Yeah, just a couple things on buyers, strategic versus financial quickly. For those of you who are relatively new to the market, a financial buyer is a private equity group or a family fund, and a strategic is a DSO, a previously existing DSO. And we hear from a lot of financial purchasers throughout the year that are looking to partner with great groups. When I look at these numbers, we hear them say that they have an entry point somewhere around $3 million of EBITDA, but they're always willing to go lower for great deals. Yep. And looking at our comps, we did a deal with a private equity group where, the EBITDA on a trailing 12-month basis was about 1.3 million. Yep. We did them as high as 11 million. And what that I think speaks to is making sure that we find the right fit and going broad each and every time. These are great companies now that are really, really happy to accelerate their growth with an inexhaustible supply of capital, and have really grown very rapidly since finding their partners.
Awesome. Thanks, Kevin. So there are a couple different things that we wanted to call out. So the top section that we have here is just the total number of deals that we did, the total average enterprise value and revenue and average revenue for the 12 months. Same for EBITDA. So the total amount of EBITDA that we did for transactions and the average 12-month EBITDA that we took to market. Our sweet spot is that $1 to $4 million worth of EBITDA. That's where we feel that, we can add the most value from an analytics phase, find the largest pool and most diverse pool of buyer types. But, we'll operate pretty much anywhere that it's a sizable business. We'll drop below $1 million of EBITDA in, for certain circumstances, but, we certainly did go upstream this year in 2021. The average enterprise value being about $21.5 million and an average EBITDA multiple of 7.6, for 236% of revenue, which is a whole lot higher than what people, used to be getting out in the marketplace at 80% of collections, the historical methodology and even what DSOs were paying 4 or 5 years ago.
Yeah, look, I'll add, we know enterprise value as a percentage of revenue is relatively worthless. But the reason we include it is because, for decades, dentists had been trained to think about their value as a percentage of revenue. So we use this as a point of reflection to show really how artificially low valuations have been held in previous decades, and now as they kind of approach what we believe is rational levels of value, the delta between, as Ron said, 80% of collections and 200+% of collections. We get asked a lot from doctors about, hey, I'm thinking about selling to my associates, and we believe that's a great course of action. And if you want to do that, by all means, you should. But their ability to pay 200% of collections compared to what a private equity-backed group can pay are vastly different. So again, we're in the business of providing information so you can make a well-informed decision. And I hope that's kind of what we're accomplishing this evening.
Yeah. So moving down to the middle section, group versus solo analysis. So obviously the vast majority of our clients are groups, multi-location practices. So 12 out of our 20 and 8 went to solo. Most of those were even probably specialty in nature.
Yeah.
If we were bringing them on, but want to focus on the EBITDA. The EBITDA size was significantly higher for our group deals, 3.3 versus about $1 million. And then on out to enterprise value, the multiple of EBITDA, 8.36 versus 6.4. Obviously solo deals always traded a little bit lower than group practices. We would say a turn to 2 turns, and that bared out last year. Also, that being said, I do think solos probably fetched a slightly higher multiple than they did the year before. I felt like it was probably a higher increase of solo multiples in solo deals than in group deals. And that's just an anecdotal piece, but I feel that that's kind of where we were.
Yeah, I think it was a function of 2 things on the solo side. One, we were working with much larger solo practices last year, nudging up to that $1 million EBITDA range. It's been rather breathtaking to see how large single location practices can get. Just this past week, I sat down with a group that has $2.7 million of EBITDA in 4 walls. There are still some really, really large groups out there. And, thankfully we've been lucky enough to work with a lot of them. I also think that there was a lot of demand out there this year that drove up these multiples. A lot more M&A activity than ever before. And our clients were clearly the beneficiary of that rising tide.
Yeah, and the final takeaway here is we don't want you all to think that we associate more locations with higher multiples. I think a few of our clients that actually are coming on board this year came to us a year or so ago and have since shed some of their locations because they started understanding that it's more important to grow their EBITDA than it is to fetch a slightly higher multiple because I've got 10 locations versus 2 locations. I don't want folks out there chasing dots on a map. I think the market is much quicker and more likely to reward a higher EBITDA that you're taking to market to fetch that higher multiple versus adding another location. So if you can squeeze out more margin on the business you have, you're probably better served than going out and trying to add a new acquisition for, the hope that you're going to fetch 2 turns of a multiple higher.
Yeah, that's well said. The number of locations, frankly, our buyers look at those as potential number of headaches, number of landlords, number of different cultures. The most valuable asset you can build is, think about trying to squeeze out $1 million plus EBITDA per location across multiple locations. To get to $1 million of EBITDA with 5 locations, all doing $200,000 each, which we see a lot, is vastly different from a valuation perspective than 2 locations doing $1 million of EBITDA. I know the one I would rather own.
Yeah.
So it's, I love how we're talking about dots on a map because all too frequently I think people chase that, but it's how much EBITDA can you accumulate in the fewest number of locations?
Yes. Yeah. Well said. The last section we want to touch on here is specialty versus GP. And I think the biggest takeaway that we had in having 70% of our practices that were specialty versus GP was we weren't the only one that saw that breakdown in deals and deals being done. So we deal with a lot of DSOs that have multiple specialties. One of the largest acquirers of GP practices in the country, if not the world, contacted us regularly asking us, are they the only ones that are seeing very low supply of family dental, general dentistry practices? And, I hadn't really thought that much of it because we were kind of swimming in the year, but it was right at the mid-year point, and then again at the end of Q3 that these groups really started reaching out, and people that were looking for GP acquisitions were having a tough time finding them. So that, and then I think the other biggest takeaway was a huge influx of new, well-capitalized, aggressive, specialty specific DSOs that existed out there that kind of shook out the trees and had a lot of people calling us asking for representation because there were some very, very aggressive business development folks out there in the world trying to get specialty practices on the cheap.
Yeah, I feel like some of the best and aggressive business development guys live in that specialty world now. They're spending millions on direct mail and email flooding people's inboxes, hopping on airplanes, buying big hunks of red meat and spending dollars on red wine. And it was an all-on assault on the specialty market this year.
Yeah, the private planes were gassed up and ready to go.
Yeah, gassed up, then emptied, and gassed up again. And so I do think that this growth in our specialty business is certainly a function of that. Specialty practices have really been left on the sidelines for a long time, right? Ortho was quick to get accepted into the DSO world, accepted in quotes, by smile doctors. But we saw oral surgery, endodontics, now periodontics, orthopedo, you name it, it's out there. And I think it shows up in our numbers here.
Yep, absolutely. We'll just touch on the multiples comparing the GP versus specialty. I think that was kind of reflected in a 2x turn-ish is something that we would have seen before. And I think this year, the specialty DSOs really turned up the gas, and that was our biggest takeaway. And I don't see them slowing down this coming year. I mean, most of them are newly formed. We were one of the very first acquisitions of a very large new specialty specific DSO. We got that deal done in June. I think that they've still got another couple years of really aggressive acquisitions before they start focusing on perhaps some tuck-ins or some organic growth or some shoring up the business before going to market.
Well, even thinking about how quickly these businesses form and recap, U.S. Oral Surgery traded this year. I still remember doing the Austin Oral Surgery trade, which was one of their inaugural trades. That was 4 years ago. So they went from inaugural acquisition to exit in about 4 years.
Wow.
And that was the first oral surgery platform here in the U.S. And now quickly others, have kind of fallen in their wake and tried to build business and are building great businesses. Once that business model has been proven out, and look, U.S. Oral Surgery traded a rich multiple, and those who were early in did really good on their second bite of the apple.
Mm-hmm.
So it will be really interesting to me to see how quickly these businesses grow and recap. It feels like the time from inception to exit for these new platforms keeps getting shorter and shorter and shorter.
Well, that'll be exciting for the market for sure. Here are just a few, actually not a few, all of our tombstones. A lot of colors, a lot of buyers, a lot of private equity groups. Some of these DSOs, like MB2, for example, here, that was recapped in 2021 at the very beginning. Very exciting deal. You've got a few platforms on here that were newly formed. One of our clients going from client to buyer, and they're out there actively acquiring specialty practices throughout the United States. So that was really exciting to see that journey over the course of 2021. And certainly next year, probably going to have another pool of 17 or so buyers.
Yeah, that's a great story, right? It's a client that we knew for 2 years, had a deal that didn't get done during COVID, got him reconnected to a great financial sponsor, and great partnerships lead to very acquisitive businesses. Mm-hmm. So someone who was a client of ours now became a buyer, and we're able to speak with deep knowledge about him as a person, him as a businessman, and about his capital partner. And he won 3 additional deals from us this year. So that was great on his part.
Absolutely.
Ron, thanks for reviewing those tombstones and the success of our clients. We now want to look back to 3 case studies of clients of ours that had received unsolicited offers, engaged us to survey the market and really bring the market to them and help them find the right partner for their growth. If you own a practice, if you own a group, there is no doubt you have received an unsolicited offer. We like it when you have. And we're more than happy to take a look at those and help you understand it. And then if you're so inclined, take you out to the broader market. The first group I want to focus on is Gendis Dental Partners. This is a story that's a little near and dear to my heart. My dentist growing up was one of the co-founders of this practice, and he and 3 other partners came in to visit us on about 2.5 years ago, and we took a look at their business, and they had 12 locations at the time, and we quickly recognized that some of those practices were not additive to EBITDA, and candidly, they were a drain emotionally and financially on the business. We provided them some guidance, and when they came back to us, they had 7 excellent locations. So we were elated to get to work with them, took them to market, had 5 excellent letters of intent, and ultimately, we were able to get them a transaction that was 61% over their original unsolicited offer that they brought to us. So they could not be happier with that transaction. And it was bittersweet to get to work with them and help them find the right partner down in Montgomery. The second group we'll profile here is Cumberland Pediatric Dentistry and Orthodontics. Brent Miller, we'd had the good fortune of working with in the past and helping him sell a couple of his other practices. He and his partners came to us and said, we've got an offer from a great group. We know them. We've had a great long relationship with them, but we just don't know if they're the right partner for us because we don't know the market the way you do. They engaged us to take them out to find them a capital partner. We looked at both strategic and financial buyers and ultimately found them a group that was able to invite them into an equity position at the ground floor at a share price of $1 and allow them the opportunity for the same upside that the private equity group is going to enjoy upon exit. Since they've completed that transaction, the business has shot like a rocket up. It is growing by leaps and bounds. And in talking to the leadership team in recent weeks, they could not be happier with that decision to partner with Spark. You want to cover Fairfax, right?
Yeah, certainly. So Fairfax Oral Surgery up in Northern Virginia, just an awesome group of owner operators, 3 partner docs that came to us, and over the years it entertained a couple unsolicited offers, one of which, I guess the most recent one that they were really thinking about was, I think, 11 months before we got engaged. So it was in hand and we had that sort of as a benchmark. We did some preliminary analytics work for them, dug in, gave them a valuation range that we felt is what the market would bear, which was well above the unsolicited offer that they received. So they were happy to go to market with us. From there, we took them to market, and it was kind of right place, right time, whereby oral surgery in early 2021 was the flavor of the month. And there were a whole bunch of very aggressive buyers out there in the market. Similarly to Cumberland, they were really excited about an opportunity of getting in early with one of these DSOs. So though they were exploring opportunities with well-established multi-specialty and well-established oral surgery specific DSOs, they ultimately made the move to go with one of the buyers that we brought to the table and well and above the unsolicited offer they received not 11 months prior. And to note, the business didn't perform that much differently in the trailing 12-month period that we took to market versus what that DSO had placed their offer based on. So I think doing the front end analytical work on our side proved to them that using us is going to take the highest EBITDA to market and ultimately yield the highest enterprise value. And then that was only further acknowledged once we ran the competitive process and really got all the buyers falling over one another to get the deal done.
Your description of Fairfax reminded me another data point on Genesis that's worth repeating. They had received an unsolicited offer. They had engaged an advisor to actually help them get to the finish line on that deal. And it fell apart in quality of earnings. And what I think our team does so well is get that number right and build a defendable position. Mm-hmm. So we don't face this retrade that we hear also often on unsolicited deals, where you go under letter of intent with an assumption of what the value is going to be based on an assumed EBITDA. The number doesn't come back quite where you thought it was going to be. And then there's an adjustment to the purchase price, which can sometimes lead to some heartache and failed transactions. It's just a lot of work to go through to get to that point. And it consumes a lot of your life to only have a deal fail. So
absolutely.
Couldn't be happier for these 3 groups. So if you're sitting on an unsolicited offer and want us to take a look, please don't hesitate to give Maggie a call.
Well, I don't know if we can sum up all the lessons learned in 4 bullet points, but we're going to try. 2021 was a great year for our organization, a great year for the industry. There were a couple very big trades that happened. One big one at the beginning with MB2, and then towards the end of the year, getting a few different, very large, very well-known specialty specific DSOs that we'll kind of dive into here in a little bit. But having those recapitalize is the term I was looking for. So over 150 buyers. I think our list is probably above 180 right now of all of the buy sides that we have contact information for, that we've got notes on, that we're ready to take our clients to within that, curate a list from that list of 150, 180 plus private equity backed buyers that exist. Even in a market with a lot of practices and a lot of groups for sale, I think Kevin touched on, there was a huge move to get a deal done, get people's deal done this year because of pending tax implications that never came to fruition. So middle of the year, we were getting calls all the time for folks that wanted to get their deal done by the end of the year. So even with that huge amount of supply of groups for sale, our clients all received incredibly high valuations and incredibly favorable deal terms, and oftentimes in record time. Some of the deals that we took on that we said we weren't going to take on because we didn't have the timeline to get their deal done, in Q3, there were some really interesting and awesome, exciting stories that came out of that.
Yeah, there were. It's fun to remember back to those conversations we'd have as leadership team saying the answer is no right now. The answer is no if they say they have to get their deal done by the end of the year. To all the attorneys and CPA firms out there that helped all of us execute those transactions, a big thank you to you all. There were moments there where it was tight for all of us. There were a lot of long hours worked and a lot of tight deadlines, but thankfully we were able to get all of our transactions closed. On this, more buyers than ever, so there's call it 150 to 180 private equity backed groups. Then there are the thousands of non-PE backed groups out there that are still using debt financing, but really understand the valuations that we've shown you previously on those slides. So there are thousands of buyers out there, and really understanding who they are, what drives, and what their culture are is supremely important to us when we're working with clients to make sure that they're thinking about who they want to hitch their wagon to for the next 5, 10, 15, 20, 50 years going forward. All right, so item 2, we had a lot of practices for sale in the market in general, right? It's one of the hottest M&A markets in the history of our industry, yet we saw valuations go up. You would think in the laws of supply and demand, when demand is the same or slightly growing, and there's a glut of supply, new practices or groups for sale, that the price would go down. And I have to imagine it did for some less than desirable assets. And I think the gap between the really great businesses and the good businesses or poor businesses probably certainly did grow this year. And we work really hard to attract the best and the brightest, and sometimes say no when taking on opportunities. And I just see the way you and your team worked the market and finding the right buyer who was willing to stretch at the right time resulted in higher than expected valuations across the board for our clients.
Yeah, it was a lot of work, and lucky for us, we've got another gentleman to help take deals to market and run these processes, because they are extensive for our clients. And but we enjoy doing it, and we actually enjoy getting to know the buy side along the way. The third bullet here, pure play specialty groups. I think we'd seen a couple over the years, but we hadn't really seen a pure play specialty DSO.
We saw Smile Doctors trade, right? But I think that what I was curious about is there are a lot fewer oral surgeons that are orthodontists, and there are a lot fewer endodontists than there are oral surgeons. So and I think the market was really curious. Okay, got it. Congratulations, you bought a bunch of these. Is there a buyer out there for them? And my God, there was. Sure. And both of these deals got done at really nice multiples. And there are other private equity groups out there who are currently building oral surgery specific, endo oral surgery specific, and they needed that trade to hit the tape.
100%.
And now that trade has hit the tape and it has proven out in the market that this is creating value, and the private equity groups upstream believe that there is additional value to be created, expect to see the consolidation of specialty increase with speed and the number of additional buyers in the space. These two transactions are in my mind, really, really big and likely transformational for the specialty space. It gives the stamp of approval that these businesses are here to stay and will continue to grow.
There are a lot of happy doctors that partnered with these groups, right? So now there's more and more stories to be told out there. We get asked the question more often than anything: am I too early or am I too late to the game? And I think that the speed that specialty will be consolidating in the years to come is favorable for those that are interested in going to market in the near term, for sure.
Yeah, so we were having an active debate over email with a couple folks about, where are we in the consolidation of the market? It's something that I know the ADA puts a number out. A lot of attorneys put numbers out. I'm in a mastermind group with some consultants who are active in the space, and someone whose opinion I believe is damn near close to right. Says we're somewhere between 22 to 25% consolidated today. I think we live, Ryan, in an echo chamber, right? We kind of have blinders on because we only live in this space all the time. We're only talking to buyers and sellers. So it can feel a little more consolidated than that, but based on where we sit in this whole economy. But there's a long way to go. Final bullet point here is that newly formed groups are moving faster than legacy groups. This is not new, but it's certainly worth pointing out. And what the point I really wanted to make here is, when they say moving faster, they're more nimble and more eager to slightly shift business plan. Like, for example, we were all endo specific, but now we're entertaining oral surgery. That is a seismic strategic shift that I'm sure wasn't made overnight, but certainly it has a huge impact to our clients in the oral surgery market as a whole. Or we've been focused exclusively in this state or in this region, and now we want to make a jump. These are the conversations I know you and your team is having with the buyers on a regular basis. And it just feels like through our meetings that they're not changing their target acquisition profile. It's evolving over time. I feel like they're taking guidance from their investment bankers and from their private equity sponsors on where value lives, and maybe window dressing their asset in preparation for a sale, or showing another economic engine for growth before they go to market. But it seems to be happening more quickly than I can ever remember.
Yeah, it does. And that makes our job that much harder, that we have to keep our ear to the ground and make sure that we have these conversations all the time, because it is ever evolving. I think that's the proper term, versus, they're not shape shifting, and they're creating a business that is the most attractive it could possibly be for when they go to recap, and they have a whole lot of very smart people advising them on what they need to do. So we're regularly having conversations to make sure that we bring every buyer that we could ever consider to our clients to create the bidding war.
I do love a good bidding war.
So now I think 2022 is upon us. I can't believe it's already. Well, yeah, I can't believe it's already mid-January.
Dude, we're halfway through with January.
Yeah, well, I can't believe it. And we've got our work cut out for us this year, but want to certainly share what we feel are very important points for 2022. We talked about a little bit earlier, the supply of GP practices. So back to that kind of angle, we feel that there was a huge amount of people that rushed to market last year in an effort to get their deal done by the end of 2021 for tax implications that didn't come to fruition. That being said, there should be a little bit of a lull in the supply in Q1 and 2, and as such, there'll certainly be rising demand from the buy side. And we've got a number of clients that we're advising them of this exact opportunity, and are going to be taking a lot of them to market. So those from the buy side on the call here tonight, we will be in market shortly with a lot of different deals. And I will say that there are a lot more GP deals in our pipeline in 2022. So I think that all of what we kind of weighed in on before is coming to bear.
The other thing, we all know the number of transactions that happened last year was huge, right? And we know that there's going to be like a little bit of a stutter in supply. But what I'm frankly tracking is the number of CEOs who are texting me, hitting me up like, where are the deals? Where are the deals? You got to remember, when you're in a private equity backed DSO, the dollars that you have in the bank account collect interest, and you have to put that money to work in order to get the return that the limited partners are expecting. I mean, I'm getting the calls and texts and emails at all hours of the day. I'm sure you are too.
Certainly.
It's a little breathtaking who all is showing up in my text string these days and who all is looking for deals. So we know this demand is real. I do believe it'll normalize out about Q3, Q4, so long as we don't see some crazy news coming from DC about tax changes here, or we see continued inflation, which could drive up costs of salaries and wages.
Sure.
Right? So we have these effects that certainly could impact it, but it just feels like Q1 and Q2, that gap between supply and demand is large enough to really cause some pretty rich multiples here.
Yeah, I think that's perfect segue into our second bullet here, is that these newly formed groups, and newly capitalized ones, that they have to grow to meet their investors' needs. So they are hounding us. We are certainly responding and keeping them apprised of everything that we have coming down the pipe. But it's just a function of the world that is consolidation, in the DSO space. I think we've said this a lot over the years, but I think it's more apparent than ever is that dental is pandemic proof. It's pandemic proof through all forms of COVID, right?
Yeah, that's right. Which variant?
The original, the Delta, and now where we are. It's proven time and time again, whereas other industries have continued to struggle. Dental has grown, outperformed. So that's just a testament, I think, to the industry that everyone on this webinar likely has chosen to be in. I think we hired somebody, or I know we hired somebody that had no dental experience, and Kevin quickly told him that, now you're in dental, you're never leaving. It was kind of the same when I joined healthcare. Once I got into healthcare, I never left. And investors in the space are recognizing it now and wanting to put capital to work in the space.
Yeah, look, there's some geographies that are still recovering from COVID, right? So tightly, densely populated regions, city doctors that rely, even downtown Charlotte, right? Here where you rely on the people to come back, and Wells Fargo and Bank of America, they're still delaying returns. So I've got friends who are dentists that have practices downtown. They're not doing great, but the market has already shown us it's just a matter of time before those come back.
Yep.
On the balance, I said this on our previous year's webinar, COVID was a horrible and is a horrible health scare. It is a horrible health phenomenon that impacted many people I know. But for the business of dentistry, it shook out some of the businesses that frankly didn't have great balance sheets, and let us know as M&A advisors who's here, who's built to last, and who's built to stay. And we got this nice rebound from all the practices showing people love to go to the dentist. People are going to continue to go to the dentist. People have to go to the dentist, take care of their teeth. So pandemic proof is a badge that I think all dentists should wear proudly.
Absolutely. Certainly need to expect to see a large flood of unsolicited offers from buyers that need to meet the demands of their investors and the business development goals that they've set for themselves. 2021 was, there a lot of people missed out on a lot of deals, that people had to, when I say people, DSOs are changing their strategy in an effort to continue to meet the goals that they have. And as such, a lot of those folks that might not have had the year that they needed to have or wanted to have are ready to go. And they're ready to spend dollars to market their DSO to you guys and put business development people on airplanes to come see you. We're here to entertain those along with you and run those processes for you.
So the PJs are gassed up.
Yeah.
Final point of note here is IPO chatter, initial public offerings. I heard a lot about this, Ryan, at the DICOMA conference. I continue to hear additional chatter about it. We saw some letters of intent with IPO language attached to them and likely financial outcomes of what an IPO could look like to a shareholder of one of these DSOs. There seems to be just too much chatter about it for it all to be false. I think we're going to see one of these businesses go public in the years to come. But the question is when and which one.
Yes.
Where do you place your bet?
Well, I mean, it happened in Canada. So for those of you that don't know, in Canada, Dental Corp of Canada did go public in 2021. So, I mean, we've at least had one data point in North America, which should be interesting for 2022.
Yeah. So what we know is all that we've heard, right? So these DSOs in the private markets, from one private equity group to another, trade somewhere between 12 to, call it, 14 times EBITDA. What we're being told about the public markets is vastly different from a valuation perspective, somewhere between 25 to 35 times EBITDA. So what we're talking about is game changing. So I would just say stay tuned on this front. We certainly are in talks with leadership that is expecting to go public, although they can, when you start talking about this world, they kind of start to shut down, right? This is a world of regulation. This is a world of meeting analysts' expectations. This is a world of the SEC getting access to your inbox. So we'll see if someone really wants to take on that increased scrutiny of their balance sheet, their strategy, and their privacy.
Sure.
All in the name of the almighty dollar. We'll see what happens.
We will see. Very exciting. So those of you on the call that have a business that want to learn more about us and just learn more about your business by having us take a look at it, we're happy to provide a complimentary valuation of your group or of your practice. We'll analyze some profit and loss statements, some production by provider reports, and various other data points to really give you a great idea of range for valuation. And we can give you corresponding deal structures, what it would look like for DSO ABC versus DSO 1, 2, 3. And I think that those exercises are really helpful. They allow our clients to look at us and give us 2 really high thumbs up. And we get to go to the market with our hair on fire for them and come back with, just a lot of rich potential buyers for them. If we didn't get the 2 thumbs up really high, we'll certainly identify some areas of opportunity for you and help you window dress your business. So when it is time to go to market, you can be comfortable and confident that you're putting your best foot forward in the eyes of TUSK and all of our experience.
Great. Ron, this has been a lot of fun. Thank you for spending time with us this evening and giving us the review and the update on the year that was and a peer into your crystal ball for the year that might be.
My pleasure, Kevin. We'll hand it back over to Maggie to send us away.
Well, that was fantastic. Thank you so much, Kevin and Ryan, and thanks to everybody who listened in. If you have any questions, please do feel free to contact me directly. Here's my email and my cell phone number. Would be happy to talk with you in more detail at your convenience. And really appreciate everyone joining this evening. Thanks so much.